Okay, let's take a look at problem 7-13, and we're going to look at the first part where they're going to ask us to put together the journal entries relating to the City of Sweetwater Employees Retirement Fund. Now, you may want to watch this presentation full screen so that it's legible for you. Okay, the information is on the on the right part of the screen, and on the left side is where we'll show the journal entries. All right, so what they do is they give us the beginning net position for the Employees Retirement Fund, and you can see that here. And then as we scroll down, we will start to see some information they provide. During the year ended, there was interest receivable on investment was collected in cash, so we can tackle that one. Well, the interest receivable was $65,000. If I slide back up and we work the first entry, we'll see that the entry they must have made, and let me move this over now so you can see that, okay, would have been a debit to cash for $65,000 and a credit to accrued interest receivable. All right, now if we look at the second information, they said member contributions in the amount of $250,000 were received in cash. The city's general fund also contributed $750,000 in cash. Okay, if you look top left, that means that $1 million in cash was received, so we're going to increase cash by $1 million, and we will accredit additions, contributions from plan members of $250,000, and additions, contributions from the employer of $750,000. Okay, next we see that there was an annuity benefits of $700,000 and disability benefits of $150,000 were recorded as liabilities. Okay, I've slid the screen so that you can see that one. And what we would have is a debit to deductions, annuity benefits of $700,000, deductions, disability benefits of $150,000. Both of those are debits, and the credit goes to accounts payable and accrued expenses for the total of $850,000. Okay, now on the bottom right, number 4 says accounts payable and accrued expenses in the amount of $900,000 were paid in cash. Looking at the top left, that entry is a debit to accounts payable and accrued expenses for $900,000 and a credit to cash in the same amount. All right, the next entry, number 5, on the bottom right of your screen says interest income of $240,000 and dividends in the amount of $40,000 were received in cash. In addition, bond interest income of $60,000 was accrued at year end. Okay, so we've got to show that journal entry next. Okay, so right above my mouse you see entry 5 here. We would have a cash. Cash would be debited for $280,000. Accrued interest receivable would be increased by $60,000. And we would show additions to investment earnings for interest and dividends in the amount of $300,000 and $40,000 respectively. Okay, the next transaction that took place is number 6 on the bottom right of your screen. You see it. Refunds of $133,000 were made in cash to terminated non-vested participants. And now if you look to the top left, it's no surprise that we've got a credit to cash for that dollar amount because we're reducing cash, and we would debit deductions - refunds to terminated employees. The next transaction you see at the bottom right says that common stocks carried at fair value of $500,000 were sold for $480,000, and that $480,000 plus an additional $300,000 was invested in stocks. Okay, now for transaction 7, we actually have 2 transactions. We have the first transaction where we show the sale, where we receive proceeds of $480,000, and we're going to show a decrease in the fair value of the investments of $20,000. That's the other debit, and the credit is to the investment in stocks. And then we turn around and we take the proceeds and invest them, plus an additional $300,000, and we invest that in stock. So we have the $480,000 plus another $300,000, all reducing cash. That comes to $780,000, and the debit would go to investment in common stock. So we've got two transactions for number 7. All right, now if you look to the bottom right, at year end it was determined that the fair value of stocks held by the pension plan had decreased by $40,000 and the fair value of the bonds had increased by $35,000. Okay, and I've repositioned the screen so that you can see transaction 8. So what do we show? We show the increase of the investment in bonds by $35,000. And we also show an increase in additions, investment earnings, net decrease in fair value of investments of $5,000. And so the credit goes to investments in common stock of $40,000. And that's how we reflect transaction 8. Okay, next on the bottom right, we have transaction 9. Nominal accounts for the year were closed, and we need to record the transactions on the books of the employee's retirement fund. All right, so for 9A, we now have to record the transaction on the books, and we have to close them out. And so you see the transaction for 9A in front of you. All the additions get debited. We've got the other accounts, additions, investment, earnings, net decrease in fair value of investment, that gets credited for the proper amounts. We've got the deductions that gets off the books, and we wind up with a credit to net position restricted for pension benefits of $332,000. So you want to study that entry and make sure you understand where the amounts come from.